August 2026. The theatrical run concludes and the final accounting is published. The Michael Jackson biopic, titled Michael, achieves an unprecedented financial milestone. It breaches $1 billion in global box office receipts. It is the first musical biopic in the history of cinema to cross the 10-figure threshold. Entertainment journalists cover the event as a cultural triumph, a testament to enduring fandom. But deep inside the financial districts of Manhattan and London, institutional investors read the news through a completely different lens. For them, this billion-dollar gross is not a movie review. It is a massive, flashing demand signal for the most lucrative, under-the-radar asset class of the 21st century, legacy music catalogs. Today, billions of dollars flow through private equity firms, pension funds, and sovereign wealth vehicles to acquire the publishing rights of legacy artists. Bob Dylan, Bruce Springsteen, Neil Young. The financialization of pop music feels like a modern corporate phenomenon engineered by algorithmic trading and private equity firms in the 2020s. It is not. The blueprint for this multi-billion-dollar machine was not drafted by a modern hedge fund. It was engineered in 1997 in a quiet room by a rock star desperate for cash and a banker looking for a loophole. They forged a contract that treated a song exactly like a physical mortgage. It was a mechanism so strange, so unprecedented, that it shocked the global bond market. The artist was David Bowie. He needed $55 million to buy his own freedom. He absolutely refused to sell a single copyright. The solution they invented birthed the modern music royalty market, survived the greatest technological collapse in the history of entertainment, and changed the DNA of how art is valued forever. The year is 1997. The global music industry is an impenetrable fortress of physical plastic. Compact discs are printing money at unprecedented margins, and record labels operate like sovereign mints. But for the artists who actually built the foundation of this empire during the vinyl era of the 1970s, the financial reality is entirely different. David Bowie is a global icon. He is also entangled in a decades-old financial nightmare. In the early 1970s, at the dawn of his superstardom, Bowie signed a management contract with a man named Tony DeFries. The terms were brutally asymmetric, reflecting an era where artists rarely understood the leverage they were surrendering. DeFries established a company called MainMan to handle Bowie's affairs, securing a massive 50% of the artist's earnings. Even after Bowie and DeFries parted ways in 1975 in a bitter, protracted legal settlement, the bleeding did not stop. DeFries retained a staggering 16% of Bowie's gross earnings from the legendary pre-1990 catalog. Every time a radio station played Space Oddity, every time a fan bought a reissue of Ziggy Stardust, every time a film license changes, DeFries extracted his cut before Bowie saw a dime. Bowie is determined to sever this financial parasite from his ledger once and for all. To buy out DeFries and reclaim total control of his financial future, Bowie needs cash. He does not need a small label advance. He needs millions of dollars in a single, immediate lump sum. But Bowie possesses a rare, unyielding principle. He will not sell his master recordings. He will not surrender the ultimate ownership of his life's work to a corporation. In 1997, the financial playbook for a musician in need of immediate liquidity is brutally short. Option 1, sign a predatory multi-album advance with a major label, effectively mortgaging your future creative output and trapping yourself in a new cycle of debt. Option 2, sell the publishing rights outright, trading long-term generational wealth for short-term survival. Bowie rejects both paths. He wants the massive capital injection of a total sale, but he demands the absolute sovereignty of total ownership. It is a fundamental mathematical paradox. You cannot sell an asset and keep it at the same time, or so Wall Street thought. To understand the hidden mechanism that broke this golden rule of finance, you have to look at the macroeconomic landscape of the late 90s. Institutional investors, insurance companies, pension funds, endowment trusts are desperate for reliable yield. They are pouring hundreds of billions of dollars into a specific financial instrument, asset-backed securities. An asset-backed security, or ABS, is a financial instrument collateralized by an underlying pool of assets that generate a predictable, recurring cash flow. Mortgages, auto loans, credit card debt. Wall Street bundles thousands of these mundane consumer debts together, chops them into bonds, and sells them to investors who sit back and collect the interest. It is a cold, mathematical factory. It operates entirely on the predictability of human debt and consumer behavior. No one on Wall Street has ever looked at a rock and roll catalog and seen a mortgage. Until a young, aggressive investment banker named David Pullman looks at David Bowie's 287 songs and realizes they are not art. They are an annuity. David Pullman is not a typical music industry insider. He is a structured finance specialist working at Gruntle & Co., a mid-sized Wall Street brokerage firm. When Bowie's financial manager, Bill Zeisblatt, approaches the capital markets looking for a massive loan, traditional commercial banks offer standard, punitive terms. They demand high interest rates, heavy collateral, and a contractual clause that would seize the physical assets, the copyrights themselves, if Bowie misses a payment. Pullman proposes a radical, almost unthinkable alternative. Do not borrow from a bank. Borrow from the global bond market. The pitch is a masterpiece of financial translation. Pullman explains to his peers that Bowie's pre-1990 catalog, spanning 25 albums and exactly 287 songs, generates a highly predictable stream of mechanical and performance royalties. Radio play, film licensing, physical CD sales. Year after year, regardless of economic conditions, the money arrives. It is just as reliable as a homeowner paying a 30-year fixed mortgage. If Wall Street can securitize a pool of subprime auto loans from Ohio, why can't it securitize the future cash flow of Let's Dance? The mechanics of the deal are meticulously engineered over months of quiet negotiation. They create a bankruptcy-remote special purpose vehicle, an isolated corporate entity designed solely to hold financial risk. This entity will issue a bond to institutional investors. The investors will pay $55 million upfront in cash. In exchange, the bond guarantees a fixed interest rate of 7.9% over a 10-year term. The collateral backing this promise? The future royalties of those 287 songs. This is the critical, grounded truth of the 1997 Bowie bond. David Bowie did not permanently sell the copyrights to his music. He used his future song royalties as collateral for a $55 million Wall Street bond. The rights were transferred to the special purpose vehicle only for the duration of the 10-year life of the bond. Once the principal and the 7.9% interest were paid off by the incoming royalty checks, the rights would revert entirely and permanently to Bowie. It is a perfect enclosed mechanism. Bowie gets the $55 million immediately. He uses the capital to execute a hostile buyout of Tony DeFries, instantly stopping the 16% hemorrhage of his gross earnings. He secures a lower interest rate than any commercial bank would ever offer a musician, and he keeps his master recordings. But for the mechanism to actually function, Pullman has to convince the rigid, hyper-conservative gatekeepers of global finance that a rock musician is a safe, investment-grade asset. He has to get the bond rated by the supreme arbiters of market risk. The credit rating agencies are the supreme arbiters of risk in the global economy. Moody's Investor Service, Standard & Poor's, Fitch, they do not care about cultural impact. They do not care about Billboard chart positions. They care only about default probability. When David Pullman presents the Bowie bond to Moody's, the financial analysts are forced to evaluate intellectual property through a rigid lens designed for concrete, steel, and sovereign debt. They audit the historical royalty ledgers. They stress test the catalog against potential economic recessions. They analyze the demographic loyalty of Bowie's aging fan base. They mathematically determine that because the catalog spans multiple decades, multiple genres, and global territories, it is sufficiently diversified against localized shocks. In early 1997, Moody's issues its verdict. They assign the Bowie bond an A3 rating. It is an absolute earthquake in the financial sector. An A3 rating is investment grade. It means Moody's considers the future earnings of a rock star to be exactly as secure as a corporate bond issued by a Fortune 500 company. It is the first time in human history a credit agency has rated intellectual property as collateral. Armed with the A3 stamp of approval, Pullman takes the bond to market. It does not even reach the open trading floor. Prudential Insurance Company of America, a massive, conservative titan of institutional capital, buys the entire $55 million offering in a single private placement. The deal makes international headlines. It is hailed across the pages of the Wall Street Journal as a stroke of financial genius. Wall Street prepares to securitize the entire entertainment industry. James Brown, the Isley Brothers, and the estate of Marvin Gaye soon follow with their own asset-backed bonds, brokered by Pullman. The music industry feels invincible, shielded by the infinite leverage of the bond market. And then, the floor falls out. In 1999, an 18-year-old college student named Sean Fanning releases a piece of software called Napster. It allows users to share MP3 files directly with one another over the internet, entirely bypassing record stores, physical CDs, and the carefully controlled revenue apparatus of the global music industry. The effect is catastrophic, unprecedented, and immediate. Global recorded music revenues, which peaked at nearly $40 billion in 1999, begin a terrifying freefall. Piracy becomes the default mode of consumption for an entire generation of consumers. CD sales collapse at a rate that defies every economic projection. Inside the bankruptcy remote special purpose vehicle holding the Bowie bonds, the mathematical foundation begins to crack. The bond was engineered on the strict assumption that royalty revenues would remain stable or grow at a predictable rate. It was stress tested for standard economic recessions. It was never stress tested for the total systemic evaporation of the physical distribution medium itself. By 2003, the music industry is bleeding out on an operating table. The predictable recurring cash flows that Pullman promised Prudential Insurance are shrinking rapidly. The bond's structural integrity is under severe threat. The rating agencies, once enamored with the novelty of intellectual property, begin to panic. In March 2004, Moody's takes decisive, brutal action. They downgrade the Bowie bonds. The rating plummets from the prestigious A3 all the way down to Baa3. It is exactly one notch above junk status. The downgrade sends a chilling, undeniable signal through the global financial markets. The illusion that music is an infallible, recession-proof asset class shatters overnight. The bespoke market for artist-backed securitization freezes entirely. No one on Wall Street wants to buy a bond backed by an industry that is actively being destroyed by internet piracy. Prudential Insurance is left holding a downgraded, highly volatile security, watching the royalty streams thin out year by year. The Bowie bond, once the undisputed crown jewel of financial innovation, now teeters on the edge of a historic default. If the incoming royalties fall short of the required 7.9% interest payments, the bondholders could theoretically seize the underlying collateral to make themselves whole. Bowie's absolute worst nightmare, losing his masters to a corporate entity, suddenly looms as a terrifying mathematical possibility. The contract that was supposed to guarantee his independence is now the exact instrument threatening to strip it away. The collapse of the physical music industry destroyed thousands of careers. It decimated legacy record labels and bankrupted global retail chains. But the Bowie bond was engineered with a quiet, structural resilience that the rest of the industry lacked. Despite the catastrophic, undeniable drop in mechanical royalties from physical CD sales, Bowie's catalog possessed a secondary defense system: commercial licensing. Synchronization placements in major motion pictures, television commercials, video games, and continuous global radio airplay continued to generate yield. The margins were incredibly razor-thin during the darkest years of the piracy era, and the Moody's downgrades reflected real, systemic peril. But the underlying cash flow never entirely dried up. In 2007, the 10-year term of the Bowie bond finally reaches maturity. Against all macroeconomic odds and surviving the total disruption of the internet, the special purpose vehicle completes its final scheduled payment to Prudential Insurance. The bond does not default. The debt is entirely extinguished.
True to the strict letter of the 1997 contract, the temporary lien on the catalog dissolves instantly.
David Bowie retains 100% ownership of his master recordings and his publishing rights. He beat the traditional labels. He successfully bought out his former manager, and he survived the digital destruction of his own industry's economic model. When Bowie passed away in 2016, his estate controlled an empire of intellectual property with entirely unencumbered rights, a direct result of the strategic liquidity he secured 2 decades prior. But the true, lasting legacy of the Bowie bond is not just the survival of one artist's catalog. It is the permanent, irreversible alteration of global finance. The 1997 mechanism proved, despite the near-death experience of the Napster era, that intellectual property could actually be securitized. It established the legal frameworks, the bankruptcy remote corporate structures, and the rating agency precedents that simply lay dormant for a decade. When streaming services eventually stabilized the industry, returning predictable, recurring subscription revenue to music catalogs, Wall Street immediately remembered the blueprint. Today, the massive asset-backed security market for music rights is booming. Billions of dollars are deployed annually using the exact conceptual architecture David Pullman and David Bowie invented. When a blockbuster biopic like Michael crosses $1 billion in 2026, it acts as a massive demand signal, actively driving up the valuation of legacy catalogs held by institutional funds. The public sees a movie. Wall Street sees a dividend. The financialization of pop culture is now complete, operating quietly beneath the surface of the Billboard charts. A massive global system built on the premise that human art is just another predictable yield. A system born because one rock star refused to sell his soul and decided to mortgage it instead. How long can culture be chopped into financial derivatives before the math breaks again?